All right, good afternoon, good Thursday afternoon, traders and investors. Depending on your take on price action in the stock market today, we've got a pretty good drawdown. At least that's where we started the day. We've seen a rally here as the trading session has progressed. Look at our screen today. This was our July 4th, 2021 weekly research report to our phenomgroup.com members. And the title, as the second half of 2021 begins, there's a lot for the S&P 500 to digest. In this particular research report, which goes out every Sunday, we talked a lot about the market internals, market breadth. It seemed like the market was already in the process of digesting a lot of the gains this year. Not necessarily at the large cap level, but at the mid and small cap level. We've seen a lot of digestion as leadership had shifted from small caps, large caps, value, cyclicals, over to large cap, growth, fan mag, and tech. So what happens when you get a lot of this digestion? Well, you get some bad breath, and it leads to indigestion. Welcome, everybody, to Finom Group's State of the Market. I am your host, Seth Golden. So let's dive right into things here. And again, just kind of looking at the market here, we've got, a lot of red on the screen, and the only thing that is largely green is VIX and VVIX, which is the volatility of volatility. So first quote of the day, as we like to kick off our weekly State of the Market, is, "If you don't profit from your investment mistakes, someone else will." That's by Yale Hirsch of the Stock Trader's Almanac. Every trade demands a thesis. Every trade demands a thesis. A lot of folks are learning that here today, maybe. I don't know. With the market, it was down more than 1.5% at its trough level this morning during the first hour of trade. There's probably a lot of people we're second guessing some of their participation, some of their positioning, so on and so forth. So every trade demands a thesis, be it an elementary or collegiate level, rudimentary or sophisticated. We need a thesis. Should not just be trading, momentum and where people are flocking to on Reddit and Wall Street bets. Got to have a trade thesis. And of course, a plan for a trade should precede the trade itself. From there, the discipline for the trade will need to endure volatility. One of the things I've been kind of focused on this week is profit taking. Again, hearkening back to our Sunday weekly research report, bad breath had not just been taking place in the previous week. It had been an ongoing developing situation beneath the index price level. It started to see these bearish divergences develop, and it just takes time. Eventually, something will catalyze the market whereby everything starts to, roll over. And I think that's where we are here today, with the market rolling over, giving us a pullback and what have you. But leading up to this point, profit taking. So in terms of every trade, you need a plan for every trade or every investment. This saying by Bernard Baruch is pretty much focusing on that. Nobody ever lost money by taking a profit. Everybody seems to have this idea of where they want to enter a stock or an ETF, where their price target entry, but for some reason we don't focus a whole heck of a lot on the exit strategy, where we want to take profits. For me this week, it was about profit taking. I've been taking profits as the market has been making new all-time highs. What better time to take profits than at highs, in stair-step fashion. The market's going higher in stair-step fashion. I'm taking profits in stair-step fashion. It's generally my game plan. Been buying Apple in the 120s, 130s, selling in the 140s, which Apple almost hit an all-time high yesterday. One of our long-standing trades that we put on in March was an Amazon July call. Here we are in July, Amazon hits an all-time high. What better time to take profits? Bottom line, nobody ever lost money taking profits. And just as essential as it is to plan the entry, it is to plan the exit as well. To keep this in mind as we progress, nobody ever lost money by taking a profit. It's really hard to get a double-digit profit. Most stocks do not deliver a 10% return a year. They just don't. There are very few, in fact, maybe a couple dozen that will do that and drive the indexes higher. So my question is, when is this 10% stock market correction not a 10% correction? How about a 20% plunge being a bit more than just crossing the line into bear market territory? What turns a bear market into something much more? Well, think about, your ownership and the stocks that you own. Let's say the market goes down 10% or that stock goes down 10%. In order for you to break even, that stock now has to go up 11.1%. Stock goes down 20%, now it's got to go back up 25% to break even. Stock goes down 50%, most people know this one. If the stock goes down 50%, then it's got to go up 100%. It has to double to get back to even. Those are the laws of financial markets. I think sometimes that, kind of is forgotten by a lot of investors and traders. So it pertains to these questions. When is a 10% stock market correction not a 10% correction? On an individual stock level, you may have problems. And what I think investors need to concern themselves with is how challenging outsized gains can be to achieve. So when you do have them, you might want to revisit this quote here and really focus in on, do I have a strategy to exit? And what are the conditions? What are the conditions for which I'm going to exit or lock in profits? Investments can gain double digits over a 12-month, 24-month period. So how are you going to lock in those profits over time? Again, this is a screenshot from within our weekly research report outlining our Amazon trade idea. This was an idea that we had highlighted on March 14th of 2021. So way back in March, when Amazon was just below $3,000 a share, took out some July call options, and that has worked out very nicely for us. But as I tweeted out earlier this week on July 6th, it hit my objective. That was the plan, to get out of it, take the profits, lock it in, and just tweeted it out earlier this week here. Plan the trade, trade the plan. All right, here we are in July. It's early July, and technically July is usually a pretty good month. But here's how July trades going back to 2000. So we look at the seasonal pattern for the month of July going back to 2000. You can see we tend to peak into about the 12th day, 13th trading day of the month. And then we get a pretty nice pullback and do a lot of sideways, choppy price action the rest of the month. This is the Russell, down, S&P, Nasdaq, and Russell 1000 and Russell 2000 there. Not quite at the 12th trading day, but we are hitting a bit of ride. We might have pulled forward a lot of gains, earlier in the first 6 months of the year. It wouldn't be surprising that the monthly seasonal calendar doesn't play out exactly as history has outlined here. Again, this is the 4th of July trading week. We looked at this last week, but I just kind of want to re-up it, given that the market is down nicely here today, although rebounding, and the VIX is starting to fall again. One of the things that I had mentioned to our members in the trading room earlier was that we had been making lower lows in the VIX, but then we hit a speed bump. Right, the S&P 500 actually hit its high point at 4330 or 4331, but the VIX stopped going down. Surely enough, we gave up about 7 points, and the VIX trended higher to about 1850, but is now rolling over again. See how that correlation works there? but it did catch my eye that the VIX stopped going down. And I said, wait, do I want to buy the dip just yet? Or is the S&P 500 about to give back just a little bit of this uptrend here since the morning or the first hour of trading? Nonetheless, all right, back to our state of the market. This is the 4th of July week. This came to us from Bespoke Investment Group the previous week. July 4th is typically a good time of year for the equity market. The illustration above here proves that point. Since 1945, the S&P 500's median gain from the previous Friday, so Friday last week, to Friday of the 4th of July week is about 0.88%. Again, that's going back to 1945. We're down now. We came into today's trading session up about 0.1%. Everybody's screaming about all these all-time highs and whatnot, but we're just stair-stepping. It's not like we're creating gaps at the open, with markets up 20, 30, 40 points. That's not what we're seeing take place. We're just stair-stepping. But the average gain over this 4-day trading stretch is 0.88% with a positivity rate of 71%. So it's up 71% of the time, and the average gain is 0.88 for the July 4th week in the S&P 500. And that's not too bad. Now, what if you're up double digits year to date coming into the 4th of July week? The gains are actually a little bit better at 1.06%. Momentum begets momentum, strength begets strength. I probably don't have to keep saying it. So one of the things we talked about, as I mentioned earlier in our previous weekly research report, is highlighted here. Again, you can see the breadth divergences. This is the S&P 500 in the top chart, making new all-time highs, closing last Friday at a new closing high. And but we've got the NYSE composite stock only not achieving, this is the advanced decline line, not achieving new highs. We have seen improvement here on the S&P 500 advanced decline line, but that also did not achieve a new high, with the index achieving a new high. Small caps and mid caps, this is the small cap AD line, this is the mid cap AD line. Again, not making new all-time highs in any of the advanced decline lines, while the S&P 500 was making new highs. So we have less participation. This is some of the, if I say bad breath, I don't, less than optimal breath that we'd like to see when the S&P 500 makes new all-times. We could have just as easily this week made new all-time highs on any of these advanced decline lines. It just needs more time to develop. That's why I say bad breath is not really the appropriate context. It's just less than optimal. You want the confirmation of that S&P 500 by way of the advanced decline lines. This also is the equal weight versus the S&P 500 cap-weighted ETFs. So the equal weight S&P versus the cap-weighted S&P, and you can see the equal weight has been downtrending versus cap-weighted S&P 500. And that, again, that's just another validation that you have weaker participation, weaker breadth in the market. Coming into this week now, again, we've been making new all-time highs. Equal weight versus cap weight tried to get going, but couldn't, rolled over again. This is high yield bonds versus aggregate bonds. It's a measure of risk appetite, if you will, right? And that's rolled over. High beta versus the S&P 500 itself, another measure of risk appetite. That's rolled over, so less risk appetite. The Russell 2000 versus the S&P 500, right? That's a lot of stocks versus the S&P 500, a lot of stocks under pressure. I mean, you put all these three together and it tells you we have a lack of risk appetite, we have weaker breadth. And here we are, we're finally getting a catalyst. What was the catalyst today to all of a sudden open down, 1.5%, 1.75% lower across the board? China, China stock market overnight down almost 2.9%. I mean, it plagued the rest of the indices in Asia, except for Australia, but 2.9% is going to do something to our markets, folks. That's just the way it works. That was the catalyst. Other than, just general weak participation that has been developing for several weeks. You have to mind the noise in the background. I'm getting some remodeling done in our house this week. So they're sawing, they're drilling, they're hammering. Bear with me, folks. So here again, Tuesday, I was looking at, well, okay, how bad are things? Or, maybe they're not that bad at this point. And this is the S&P 500 in the top of the stack chart. This is the percent of S&P 500 stocks trading above their 50-day moving average, which yesterday or 2 days ago finished at 47%. And the bottom panel is S&P 500 stocks that are within 10% of their highs, right? So basically right at, correction territory. 63% of stocks were within 10% of their highs. Same chart, S&P 500 at the top, but this one is within 5% of their 52-week highs. Only 33% of stocks were within 5% of their 52-week highs. Again, a lot of stocks underneath the surface have already been correcting. And all it really takes is a catalyst overnight, thinking that China might have been that catalyst. And, a lot of people will point to the bond market as well. We've seen bond yields break down below that 1.4% level, then 1.3%. And today it troughed at 1.25% on the 10-year yield. But since then, just like the S&P 500, bond yields went back up to 1.3%. And we've been hovering around 1.9, 1.29, 1.3, basically since 10:30 this morning, which is when the S&P 500 also troughed this morning. See how that works? All right. And again, here's just a closer look. S&P 500 stocks above the 50-day moving average as of yesterday. With the S&P 500 moving higher, it did, help. It had some support. We bounced up to 51%. Nasdaq, same breadth metric, above the 50-day moving average, however, fell pretty sharply. And that's on an up day. Nasdaq was up yesterday also, but this has plunged down to 41%. The percentage of stocks trading above the Nasdaq 50-day moving average, 41%. Another breadth indicator been watching in terms of, the advancing stocks versus declining stocks. You can see this is the Nasdaq here. The number of declining stocks has been trending higher. So, just goes to show you these cap-weighted indexes can continue to go higher for longer than you think, even though underneath the surface of the indexes, things are breaking down. It's often why I say when we have good breadth, right? If, we had low readings here of declining stocks, when we have good breadth, there's not really a whole lot you can do because you don't know how good it'll get. You don't know how long it'll last. And you're just kind of following the trend, riding your positions. It's not terribly actionable, good breadth. What is actionable is bad breadth. Like on pullbacks like today, you want to have that shopping list. You want to have those stocks and ETFs that you're ready and waiting to buy. Everybody complains. The S&P 500, the biggest decline we've had all year is 4.2% on the closing basis. Well, here you got a nice pullback today. Intraday trough, 1.75%, give or take. What were you doing? Were you listening to CNBC and those jokers tell you that the bond market's sending you this signal about the economy and that signal about the economy? Because that's crap in a nutshell. That is just absolute garbage. Jim Cramer coming on TV. Well, this is possibly as good as it'll get, and maybe that's why the bond market is saying, or there's a fear of a Fed misstep, blah, blah, blah. All this morning, everybody, clamoring about, what the bond market is signaling. In my opinion, it's crap. And I'll tell you why it's crap. Let me scroll down here for a little bit. Some really good notes here from Wells Fargo. If you've been following nominal rates or nominal yields and real yields, the bond market's not sending you any signal. The drop in nominal yields has been associated with a nearly 1-to-1 correlation or ratio decline in real rates. When that happens, in other words, inflation expectations have been stable, suggesting economic forces are not at the heart of the bond slide or the yield slide, the rate slide. When they're moving together, it's not about the economy. Good notes here from Wells Fargo. Check it out at your leisure, folks. But I did want to bring that to everybody's attention. And really, Jim Cramer, come on. Remember this? The VIX is flashing signs of more market downside because Mark Sebastian, his VIX guru, says that we're getting into an area of volatility swells as opposed to volatility spikes. Right? That was May 18th. What happened as soon as this, was delivered from Jim Cramer and Mark Sebastian? Right? The market did nothing but go higher through the rest of May and all of June. And the VIX made what? A new all-time low. Well, a new post-pandemic low. Like strike one. And of course, last night, charts suggest stocks headed higher despite present risk. Who's he referring to again? Mark Sebastian. Doesn't it serve to figure? Immediately, that's July 7th, today's July 8th, immediately we're down. Like the two of these guys really need to separate, go to their separate corners, not rely on each other for any, stock market analysis. This is probably the best contrarian signal we've had since Gartman and the Gartman letter. All right. I'm being a little hyperbolic there. Okay. What do we got here from Steve Depp? Everyone knows the phrase sell in May and go away. So this is the most recent study from Steve Depp looking at the Nasdaq. What about a new all-time high in July is a time to buy for the Nasdaq at least? If you look at it, it's happened going all the way back to 1979, 14 times. In all previous 13 occasions, 1 year later, 100%. Never read 1 year later. The worst return was 2015, 0.64%. That was the worst. So 1 year later, undefeated. New all-time high in July for the Nasdaq is a time to buy. Thinking long term. 1 month later, Nasdaq is up nearly 70%, 1% average return, nearly 70%. 2 months later, average return gets a little better. 3 month gets a little choppy here. It's a 50-50 toss-up. 4 months later, gets that much better, 77% return, positive, 6.6% on average profit. New all-time high in July for the Nasdaq is a time to buy, undefeated a year later. We came into the week knowing that the Nasdaq was also up 7 consecutive weeks. Also suggests the week 8, which we're in right now, we came into today's trading session up 0.16%. So again, it hasn't been a gangbuster week here, and it is a holiday shortened trading week. Mean return on week 8, 0.89%. Odds that it's positive are 82%. Now, right now, things are looking rough for this. We're down 0.48. We're actually at the best level of the session here on the Nasdaq, basically only down 0.5%. So who knows? Tomorrow we have a good session. We might be in the money again. This might have a better, even better odds being up. Week 9, Week 10, Things get a little bit more dicey, it looks like, but still with positive returns across the board. So we're up 7 weeks in a row. This week, history says we should be up as well, but there's going to need to be some buying coming in. Another metric telling you just how frothy things have gotten, at least for the Nasdaq. I mean, the Nasdaq has been on a tremendous run basically since it had a 12% correction earlier in the year, then it had another 8% correction, but ever since that trough of the 8% correction has rallied to new highs. It's made 18 new all-time highs this year. But looking at the Nasdaq 100 buy to open 10-day put call ratio, in the orange, the 10-day put call ratio, it hit a 7-year low reading just below 0.36 yesterday, the lowest reading since July 2014. People were, on the put call ratio, people were optimistic. People were optimistic as the Nasdaq's doing this, the ratio's doing this. It serves to figure we hit a trough point and we get a little pullback in the market, get a chance to reset, at least sentiment. Again, this was a study we looked at also last week. When the S&P 500 is already up in the first half of the year, greater than 13%, which it was, through the first 6 months of the year, the S&P 500 was up 14.4%. But when that happens, July, there's a lot of red on the screen. There's a lot of red years in here to take note of. The average return is still usually green with a 1.4% average return in the month of July with this qualifier, but the positivity rate or the win ratio, 50-50. Just as many years have been down as there has been up. It's a 50-50 crapshoot. Now, the second half of the year, we still tend to have a good return with a 67% win rate. I guess we're good as long as we stay away from 1987. Now, keep in mind, 1987 was a different beast. We were up 14.4% at the end of June, the first 6 months of the year. Look at 1987. It was up 25.5%. Look at 1943, up 26%. 1983. Notice anything different? These years had that much more gains than 2021, and they were red in July. And some of them were red the back half of the year. We were up 14.4%, not quite as much as some of these highlighted in red. Something to keep in mind. All right, S&P 500 second half return. This is another study. We're trying to narrow things down here. The S&P 500 gained 14.4% in the first half of the year, going back to 1950, when there's been a double-digit gains in the first half. It averaged a gain of 7.58% in the second half with an 81% positive rate. All right, that's one way of looking at it. And again, we were up 14.4% as of the end of June. Second half return, what about if it's between 10 and 15%? That's happened 11 times going back to 1950. It's happened 11 times before. What I want to know about is the drawdowns. For the first half of the year, for the first half of 2021, the largest pullback has been 4.2%. That was February 12th through March 4th. That's the ninth smallest first half drawdown for the S&P 500 going back to 1950. When the max drawdown was less than 5% in the first half of the year, the index averaged a return of 8% in the second half with an over 80% positivity rate. So max drawdown in the first half of the year, 5% or less. It's happened 17 times before. The average return, 8%. positivity, 82%. If you've had bigger drawdowns, the positivity rate is worse, the returns are worse. If you've had an over 10% correction in the first half of the year, you got a 50-50 shot just about in the second half of the year, but still the average return is positive 4%. It speaks to momentum. People are willing to buy the dip. It's an appetite. You can gauge the appetite here. All right, what about when the first half of the year, the returns are over 10%, but less than 20, wait, let me see. The table here separates the 17 returns here where the max drawdown was less than 5% into the S&P 500 was up by more than 10% or less than 10%. So if we were up more than 10% with less than a 5% drawdown, the average return was 9.77%. That's us this year. We were up more than 10%. We had less than a 5% drawdown in the first half of the year. Average return, back half of the year, 9.77%. The positivity rate, almost 80% again. Now, this one goes all the way back to 1928. This study here goes back to 1928, pretty much looking at the same thing. Average drawdown, 0 to 5% drawdown, which is what we qualify for here in 2021, and a presidential cycle first year. After an above average first half, which this was an above average first half of the year. So we connect all the dots. An above average second half tends to follow an above average first half. So the data above goes back to 1928. The S&P 500 has now put up new all-time highs each and every month for 9 straight months. Only other months that match that, January of 2018, March of 2014, October 95, July 86, November 1954. When the S&P 500 has an above average first half during the presidential cycle first year, 78% of second half drawdowns are 10% or less. 67% of drawdowns in the range of 0 to 5%. That's right here. So in terms of thinking how much can we pull back, these studies help you to understand. And so far, it's looking like less than 10%. History has does a pretty good job, if not repeating, definitely rhyming. Long new high streaks for the S&P 500 index have bulls smiling. We were up 7 days in a row, then we had a down day, and then we were up again. But when you have a streak of 7 consecutive new highs, and finishing the day positive, it's a rare occurrence. The S&P 500 index was recently higher 7 consecutive days for the first time since last August. But even more impressive is on each of those 7 consecutive positive days, the index made new highs in each of those days. You can see what the returns are 1 month later, 62% positivity rate, 1.6% gain. 3 months later, 100% positivity rate. 6 months, again, this just really speaks. We're trying to cover all the bases in terms of what's taking place in the market. Yeah, COVID is a new set of circumstances that this particular cycle is contending with. But human behavior is rather constant, especially investor behavior. So these are the probabilities that we have to work with. And pretty much every study that we've already touched on here today is pointing to further gains. If not this week, in the not too distant future. Volatility does tend to start rising in the month of July and further into the month of August. It's usually around the third week of July. It's usually around the third week of July. But just like the July seasonal S&P 500 and Dow calendar, don't be too surprised if this pulls some of that forward and sooner. We got above 21 on the VIX today in the pre-market. Got above 21. All right, thinking of the macro picture, right? Thinking broadly, and I mean, what is going to drive the market? Well, it's going to be earnings. Well, what's going to facilitate those earnings? Well, it's going to be the economic output, right? It's going to be GDP. Goldman Sachs was out with a note just the other day. U.S. demand growth has slowed since the March-April surge. Post-pandemic labor and goods sector shortages are weighing on output, and the spread of the Delta variant is offsetting vaccination-related progress on new infections. I don't see it. I don't see it in the data. I'm sorry, I can't get behind what they're promoting here. Look at Johnson's Redbook retail sales. This comes out every week. All it's done is accelerate. All it's done, that's retail, that's consumer spending. 3/4 of our economy is consumer spending. I cannot get behind what Goldman Sachs is suggesting there. Here's card spending data. Here's card spending data. Here's March, and it's done nothing but trend higher as well. Retail, food services, I mean, I don't see it. I'm not seeing it. This is 2021's full year forecast for retail sales. I mean, it should slow into next year. I mean, the comps are going to be very difficult. We're setting a high bar, so to speak. But sorry, I'm not getting it from what we can see on the ground, even in the high frequency data, which this is, the Johnson Redbook. This comes out every week. So it's a good snapshot in between the monthly Census Bureau national retail sales. You combine that with the card spending data, come on. Buy the dip, right? I mean, I've been in this market today. I was taking profits last week. I've been taking profits this week. It's been part of my game plan, doing well this year. I hope everybody's doing well this year with the market up 14+%, 15%, as we've trended higher this week. But you have to have that game plan to take profits. Why? So that you can put it back to work and compound your gains. When the markets do pull back, the markets will inevitably pull back. One of the reasons you need to be a dip buyer, because I hear it every day now for some reason, well, there's no more stimulus checks. So maybe the best is in. Maybe that's why the bond market, maybe that's why yields are sliding. Maybe that's why there's another rush to, buy treasuries. And in my opinion, that's crap. No, I'm sorry, the stimulus checks are not stopping. Remember the child care tax credits. They start this month. Direct deposits. You got children under the age of 17, as long as you qualify at an income level, you get $300+ per child as part of the rescue plan that was passed back in March. That lasts through the end of the year, every month. Qualified taxpayers will be getting $300+ per child. Stop telling people that, the stimulus checks have stopped. What used to go for paying, maybe daycare expenses, VPK expenses, is now going to go to other things. Why? Because parents are getting those checks from the government. Those government transfer checks are still going to roll out through the rest of this year. Secondly, why you need to be buying the dip, besides a continuation of our economic expansion cycle is another tailwind for the expansion cycle outside of the consumer. It's CapEx spending. Strength in CapEx has a positive spillover effect on the rest of the economy, resulting in increased manufacturing activity, job creation, wage growth, which will provide another boost to consumer spending and eventually faster productivity growth. That's what this chart shows. I mean, we're going to get record levels here in CapEx spending. This is a huge, this doesn't just roll over without another exogenous event either. So in terms of maybe the S&P 500 has priced in a lot of the good news, which I don't discount. I'm sure it has. That's fine. Don't buy at the all-time high if that scares you. Wait for a pullback, but execute on that pullback. Don't worry about, well, there could be more downside, and Jim Cramer said this, and they had Muhammad Al-Arian on CNBC saying that. And they got Mike Wilson on Bloomberg saying this from Morgan Stanley. Don't worry about all that. These are your macro fundamentals. This is what's going to drive earnings, and earnings estimates continue to rise. $191.31 is the consensus forecast EPS for 2021. By the way, firms are upwards of $200, $210 a share at this point. There are firms above 200. More than likely, this is going to be above 200 by the time we're said and done with the earnings season. Wait till those big tech companies start reporting. You're going to see a big jump in this. Next week is the kickoff, the true kickoff of earnings season with JP Morgan, Goldman Sachs reporting next Tuesday. Pepsi also gets intermingled with that on next Tuesday. So you got the financials, you got the big money center banks and insurers all reporting next week. And, a couple weeks after that, you've got, all your big tech titans. This is a perfect dip ahead of that. This is the perfect opportunity. Apple almost hit the all-time highs yesterday, pulled back to 141 in the pre-market, down $4, $3 and change in the pre-market. That's a nice gift. And I hear, if we look at current S&P 500, the PE ratio, because that's another concern. You don't want to buy at all-time highs. You don't want to, buy with the PE multiple above 20 and near levels it hasn't seen since the dot-com era. I'm not concerned about valuations. I know valuation is not a measure of forward 12-month S&P 500 returns. There's literally no correlation there. But what I'm also aware of is that high valuations tend to coincide with a new expansion cycle. You get higher valuations that persist. You'll get persistent high valuations until the next recession, great financial crisis, or a recession scare like we had in 2015 into 2016. But here's the other thing you'll notice. If we drew a trend, let's do that. Right? Let's say we draw a trend line here. We'll start at the peak here. Whoops. I should be able to. Maybe not. There we go. Oh, look at that. 2018. Right? Look at the slant. We broke the trend line. Look at it now. PE ratios go higher over time. You don't know how high they're going to go. You don't know how long it will persist. Like, this is not a good, valuations are not a reasonable rationale for why I should or shouldn't buy. They're just not. But what this chart does prove is that valuations, this is the PE in the bottom panel here, valuations do trend higher over time. And we've spent a good amount of time, trending higher here in the previous expansion cycle before, of course, COVID crash here. So I'm a buyer of the dip. I don't see anything in the bond market that is signaling anything ominous about the economy. I think we're getting a good bit of, indigestion here from, the previous gains that need to be digested. That's all. And when you get this drawdown, and when it's broad-based, it kind of resets everything to where we could possibly even get a bullish breath thrust if we all of a sudden get that momentum back with broad participation. Remember, small caps and mid caps have had their 10% correction. Before that, it was the Nasdaq. Notice what's taking place. It's just constant rotations. That is the sign of a healthy bull market. You're getting these rolling corrections. What if they all unify once again? I mean, we got rates down to 1.3%, folks. I mean, the Nasdaq tech, they should perform well here. They should perform well for all of the, the narrative about, tech not performing well with rising rates, so on and so forth. At 1.3%, come on. People were saying that when it was 1.5, 1.6, 1.75% on the 10-year yield. Why couldn't everything just coagulate once again and coordinate an effort to move higher and possibly set up the perfect, bullish breath thrust? Maybe it's a zwig breath thrust. Maybe it's a breakaway breath thrust. Who knows? Maybe I'm being too optimistic. But with that said, I hope you've enjoyed this week's State of the Market. If you'd like to receive this in real time, make sure you join us at phenomgroup.com. As I always say, trade safely and be in touch.